Shriram Finance has been one of the standout stories on the Indian market, up nearly 60% this year, crossing 3 lakh crore in assets and landing Japan's biggest bank as a partner. And in the next few minutes, I'll break down the fundamentals and the charts. Let's get into it. First, what are we dealing with? Shriram Finance is India's largest retail-focused NBFC. Think loans for commercial vehicles, tractors, gold, small businesses and two-wheelers. It's the flagship of the Shriram Group. As of early July 2026, the stock trades around 1040, off its all-time high of 1108, with a market cap north of about 2.4 lakh crore. It trades at 24 times earnings and 2.3 times book, reasonable for a franchise of this quality. Now the numbers. In the March 2026 quarter, net profit jumped almost 41% year-on-year to just over 3,000 crore, beating estimates. Assets under management crossed the 3 lakh crore mark for the very first time, a milestone that puts Shriram among India's largest lenders. And profitability is best in class, a return on assets of 3.6% and a return on equity of 19%, a blockbuster quarter. But here's the catch, that 41% is a quarterly number. For the full year, reported profit was basically flat at around 10,000 crore because the first half of the year carried elevated credit costs and last year's figure had a one-off gain. Take that out and normalized full year growth is a much healthier 21%. Asset quality is the metric to watch for any lender. Gross bad loans sit at 4.58%, a tiny uptick from the prior quarter. But net NPAs actually improved to 2.33%. And crucially, provision coverage jumped from 43 to over 50%. That means the balance sheet is far better cushioned against losses than a year ago, stable with a stronger safety net. The transformational event is MUFG, Japan's largest bank, bought a 20% stake for nearly 40,000 crore, one of the biggest foreign investments ever in an Indian NBFC. That pushed capital adequacy toward 34%, and the company swept AAA ratings from every domestic agency. Deposits grew almost 24%. This means capital, credibility and cheaper funding, a serious strategic anchor. So what's next? Management guided for 15 to 18% loan growth in FY27, with gold loans and passenger vehicles leading the way, and a cost-to-income ratio in the mid-20s. At 24 times earnings, the stock isn't cheap, but it's not expensive for a lender compounding at these returns. The quality is clearly there. The question is what you pay for it. The long-term trend is firmly bullish. The stock trades above its 50-day and 200-day moving averages, and it's massively outperformed the Sensex, up over 50% while the index fell. Momentum is neutral, not overbought, not oversold. Let's weigh it up. On the bull side, elite profitability, 3 lakh crore in assets, stronger provisioning, MUFG's backing and AAA ratings. On the bear side, flat full-year earnings, that small uptick in bad loans, the cyclicality of commercial vehicle lending, sensitivity to interest rates, and a stock already sitting near record highs. Strong business, but less margin of safety after a big run. Bottom line, the fundamentals are strong and improving. The trend is intact, but it's closer to the top of its range than the bottom, so timing and position wise matter. This is education, not financial advice. Always do your own research. If this helped, hit like and subscribe, and I'll see you in the next one. Thanks for watching.